Happy Friday, everybody. Colin Harper, joined as always by Michael Kutch. Just wanted to say a big thank you for joining us here today. So Mike, it's been a hot minute since we caught up. I know last Friday was Good Friday, market closed. We were all kind of traveling, so I hope everyone listening had a fantastic Easter and little holiday with the family. Just a quick recap. Today we're going to do a little catch up because we're a week behind. So Mike will get us caught up on what he's seeing going on in the economy and the markets. Today's all about IRAs. So we're going to talk a lot about IRAs, some considerations. We often get asked the differences between Roth, traditional, what makes the most sense for me. We might not be able to answer that, but we can give you some food for thought and be happy to continue that conversation off of Friday Live. But as always, nothing we talk about is a specific recommendation. These are just our opinions, our ideas, and we would encourage you to consult with a financial professional that you're working with or us if you have some specific questions to your situation. But with that, Mike, I know Mike was out west. He got to see his new niece over the holidays. So congratulations, Mike.
Thank you.
I gave him some advice before he left. I said, it's really easy to become the favorite uncle. You just make sure you drink a lot and talk about politics during the holiday season. So,
that always goes over well.
It always goes over really well. But,
it was really nice meeting my niece. She's very, very cute.
That's awesome. I can confirm that. Everybody says babies are cute, but I saw pictures and I can definitely confirm that. So,
and I got a couple days of skiing in too.
That's awesome. That's awesome. So big
I got
congrats.
back on the snowboard for the first time in about 10 years. I'm much worse than I remember. But I did get one day of skiing in, which restored my confidence a little.
It's amazing how that happens. You kind of build these things up in your mind, and there's a lot of things like that happen in life, right? If you, Mike, what was your favorite candy as a kid? Do you remember?
I really like Butterfingers.
Butterfingers. When's the last time you had a Butterfingers?
Probably about 5 years ago.
Okay. And when you had that Butterfingers 5 years ago, was it as good as you remember it from being a kid, or was it disappointing?
It was very disappointing. I just remember it just gets stuck in your teeth, and
yeah,
I'm not going out and buying anymore.
And I think that's, I think we hold on to the nostalgia of our youth, and it oftentimes is tied to candies or sweet treats or snacks. And then years and years later, when you have them again, they're not nearly as good as they were when you were a kid. And there's a specific psychological reason for that. And I actually heard a really interesting podcast on it. And I can't remember what it's called for the life of me, but if I do remember, I'll throw it in the comments down below. But but there's a reason that, we remember these things. And I think it's because it's tied much more to memories than the actual taste behind that sweet treat we remember as a kid. So speaking of things I remembered as a kid, it seems like that long ago when we had good news about the market. But Mike, get us caught up here for, what's been going on so far in this, since I guess it's been about 10 days since we caught up with everybody last.
Yeah, I miss the markets where it just goes up every day.
It's easy.
We'll get back there eventually. Yeah, so I'll just do kind of a little recap of all the economic numbers that came in. Overall, the decelerating economy theme is still intact. Nothing too drastic there yet. We had the banking issues way back. I guess that's about a month ago now. And we haven't really seen further contagion yet, but we did hear from some of the big banks today, and no real red flags there yet. Although a lot of them were more beneficiaries from the banking crisis because they got a lot of those inflows. So I'm really interested to see how the regionals earnings come out in the next week. It might take a little more time for that to transpire, but regardless with those, even if we've seen somewhat of the last of the poor interest rate management, which I'm not completely convinced of. But I think the bigger issue is a lot of those deposits went to bigger banks. And then the other thing, it really opened up the eyes to everyday people of what you can get in a money market, say 4.5% ballpark or a treasury. So I think a lot of them might have taken that approach and tactic and gone that way instead of getting thanks Siri instead of getting 0.03 on your savings account. So we'll have to see how that transpires. Either way, I think it's going to be a more difficult lending environment, which particularly affects the small businesses,
Oh
which
yeah.
make up such a large part of the economy and the employment situation.
Well, I think that
So
makes a ton of sense. And even in our practice, we have seen, there's a series trying to get involved here.
she wants to be
Big
on Friday Live.
Hey, big brother's watching. He ain't gonna leave us alone. So, I think even in our practice, we have seen a lot of inflows on the money market side of things. A lot of people have cash on the sidelines that they may need in the not too distant future. So it doesn't make sense to expose it to market risk. But money market rates are absolutely phenomenal compared to what they have been for the last decade plus. So certainly seeing that in our practice as well as in the bigger picture. And you're right. I think a lot of people are just kind of getting fed up with the banks making money off their money, and then all the noise of and concern over the regional banks recently in the news has certainly, I think we've seen a lot of flows out of deposits at banks and into other instruments that are certainly paying a lot more than those savings and checking accounts at banks. So I would definitely seeing that, not only Mike in the big picture, but also in our practice as a whole.
Yeah. And then to touch on some of the like specific economic numbers, the ISM, manufacturing, non-manufacturing, we're both a little weaker, especially on the manufacturing side. We got retail sales today, which came in below expectations, dropping 1% for the month. However, it looks bad from a headline perspective, but I think a lot had to do with the decline we saw in oil prices and gasoline specifically. Now, unfortunately, that trend's kind of reversed in the past couple weeks, so we'll have to see that going forward. But overall, people are still spending like the theme of the past 6 months. It's been a little more selective. They're doing more of the service related activities than more purchases on goods. We saw that in the Costco numbers too. But they're still overall. I mean, they just started in such a healthy place. They had so much built up savings, and even now it's I think 1.4 trillion in excess savings. Whether that comes off the table or not, I'm not sure, because we are seeing high levels of credit card debt currently, very high levels. Now, in terms of if you look at that in terms of disposable income, it's really not that alarming of a level yet, but it's going to take some time for that to come off. Fortunately, the inflation data looked pretty good this past week. Both CPI and especially PPI came in lower than expected. So whether that takes the Fed off the table or not, I think, I mean, they've been saying it for 6 months. They're getting to 5 to 5.25. I think they're going to do that at the very least. Whether it's a mistake or not, we'll see. We did get the Fed minutes this week. That's the minutes from their last meeting, which was almost a month ago now. The only thing in the messaging was they did say their base case is a mild recession this year. They haven't come out before and said that, even though the projections kind of signal that. I mean, they project the unemployment rate going to 4.5% from 3.5% this year. I mean, you can say whatever you want. That's a recession.
You read between the lines on that one, right? They may not have come out and said it until now, but they've been hinting at it for some time.
Yeah. So, I mean, the big question will be whether they do ultimately cut rates this year. And right now, the market's kind of expecting that, but I think they're skipping the part where they're afraid of the actual recession itself. They just fast forward to the point where we cut rates and get the lending environment a little better, and let's accelerate this economy.
Yeah, I mean, we're in the instant gratification society now. Why wait and go through a whole recession cycle? Might as well just speed right to getting things going.
Yeah, I mean, the market is a forward-looking mechanism, but I don't know to the point of like a full 12 plus months out.
Yeah.
So personally, I still think we get another dip lower here. We've been kind of in a pretty tight trading range the past couple weeks. We are grinding higher a little bit. From a technical perspective, it looks like we have a ascending triangle formation, which is typically a bullish thing, but if it's within a larger downtrend, which at this point, I don't know if you can really say it's part of a larger downtrend. I mean, we've had 6 months of contraction and now 6 months of ascension. But yeah, I'm still a little biased to the downside. So we're still conservatively positioned. I actually took about 2% off our equities yesterday and added to, we were slightly underweight fixed income. We're slightly above neutral now, nothing big moves, but we're sitting on that healthy cash position. And fortunately, you're paid to wait right now. You can get, like we talked about, attractive yields in money markets or things similar to that.
Absolutely. And I think that's a great point. I mean, what are you looking forward in the coming weeks, Mike? Anything that's got your interest peaked?
Yeah, I mean, nothing too substantial on the economic front. It's really all going to be about earnings. I think we'll see some regionals next week, and then in the next 3 weeks we'll have the majority of the S&P report. So that'll really, hopefully, the Fed's looking at that to dictate their next move. I think they're probably predetermined, preset to do the 25 basis point hike to 5.25, but we will see.
Very cool. Well, hey, thanks for getting us caught up, and definitely looking forward to how this develops for the rest of the year. Thanks for staying busy. I know it's a bunch of work staying up to date on all this, and I'm very happy I don't have to do it. So as always, thanks for the insight. So we'll kind of move into the planning topic, and it's all about IRAs. So one little fun fact I pulled out of this day in history is on 1865, Abraham Lincoln was shot on this day here. So the theme for today is don't shoot yourself in the foot with IRAs. Okay. So we're going to try to learn a little bit more about them so we don't shoot ourselves in the foot as far as IRAs go. So let's talk about the very, very basics of it. So the two most common, right? We'll talk about Roth IRAs and traditional IRAs. So Roth IRAs, your money goes in, and it goes in after you've paid taxes on it. And so what that means is you don't get a deduction for any money that goes into a Roth IRA, but when it comes out, that money's tax-free. On the flip side, a traditional IRA, you do get a deduction for, and that money grows tax deferred. But anytime that money comes out, you're going to pay your normal income tax rate on it. Traditional IRAs and 401ks from kind of a tax perspective function the same. You do have the option in a lot of plans to opt for a Roth 401k as well. So those are just some of the very, very basic things. So let's take kind of just a sample client and say, should I make an IRA contribution? I think that depends on a lot of things, but we'll answer it in kind of very general terms. One of the most important things to figure out if you should be making or you have the ability to make an IRA contribution is, are you covered by an employer-sponsored plan at any part during the calendar year? So what that means is if you work for a company and you're eligible to participate in their 401k or their 403b or any type of retirement plan they have, you need to pay attention to they have what are called phase outs for, and I'm only focusing on Roth phase outs right now because generally our recommendation is skews towards Roth IRA contributions because we are under the opinion, and for this isn't a wide sweeping fact for everybody. Some people it makes sense to take that deduction, but our thought is generally let's do as much as we can to build up a bigger tax-free bucket because long-term, we believe that has a bigger impact when it comes to financial planning as a whole. So that's our philosophy as a firm. It doesn't fit for every single person, but for, kind of just general ideas, we try to focus on building up that tax-free bucket for later on down the road as much as we can. So first you need to ask yourself, hey, am I covered by a plan at work? Can I make an additional Roth contribution versus what I'm making at work? So if you're single or head of household, Roth phase outs for single begin at 138,000 of AGI. And so what that means is if you're making more than that and you're reporting more than that of your adjusted gross income on your taxes, the amount you are actually allowed to contribute to a Roth IRA starts to decrease. And then once you get above 153, you cannot make a Roth IRA contribution. You may have heard of a backdoor Roth. There are ways to still make Roth contributions, even if you're above that limit. It gets a bit more complicated, but we can certainly talk about that later on. If now for married filing jointly, the numbers are a bit more pleasant. So between, if you're making under 218,000 of AGI, then, you can both of you could make a Roth contribution, no problem. We also really like the idea of simplicity when it comes to IRA contributions. So the first question you should ask yourselves is, are you at least contributing up to the match inside your employer's 401k plan or 403b? Does your employer offer a Roth option inside of there? Because, our bias is to building a bigger tax-free bucket in retirement. And a lot of people don't realize that they have a Roth option or a, tax-free option available to them inside of their 401k. And that's a very good way to park tax-free money. So another benefit to 401ks and Roth 401ks, 403bs, things along those lines is they have much higher contribution limits than the traditional IRAs do. So there's a fairly substantial difference there. So in an ideal world, what would happen is, say you're a married couple and you're making 215,000 and you've got you've done a good job managing your expenses. At least one of you is maxing out a 401k or a Roth 401k, and then you can both make Roth IRA contributions there as well. So what I like to tell people is don't worry about it too much. Work with your whoever's doing your taxes, or if you're working with us, just give us a heads up. If you're going to be around that 200,000 mark as a married couple, just give us a heads up and we can help you plan for that. That's kind of an easy number to remember. This kind of goes up every year, and so it's 218,000 here in 2023, but it creeps up every year. So I just tell people, if you're around that, if you're over that 200,000 mark and you are interested in making IRA contributions, let us know. And we go through this in our comprehensive planning for the folks that this applies to as well. But just wanted to give a quick thing. So in our opinion, building bigger tax-free buckets makes sense. And
Hey, I got this question yesterday. I don't know if you have any insights on it. So I was talking to someone that said, is it beneficial to do an IRA contribution, traditional, a non-deductible one if you're over the income limit? Do you know what type of scenario that would be beneficial?
Yes, and that really comes down to wanting to build up a bigger tax-free bucket. So and that's kind of what I mentioned before, Mike. That's a great question. That's part of the process in what they call a backdoor Roth. So you make a non-deductible IRA contribution. So you don't owe, you're not getting a deduction on that IRA contribution, but you can take that non-deductible IRA contribution and convert that to a Roth. Now, where that makes the most sense is anytime you convert money from a traditional IRA to a Roth, it's not just that account. They look at all of your non-Roth IRAs and that whole balance, and that's how they base kind of the tax calculation on it. So that scenario still certainly works for a lot of those people, but where I see that work the best is if the bulk of your asset is in Roth or Roth 401k accounts, or most of those like tax-free bucket accounts. That works a lot better than if the bulk of your assets is in traditional IRAs, because so yes, it's still a great strategy and it works. And I would say the big things you want to focus on that is the younger you are, the general, and this is very, very general. The younger you are, generally, the better it works, because the more time you have to kind of recoup the taxes you paid and let that tax-free bucket go. Okay, so the younger you are, the better. The less amount of traditional IRA assets you have, the better. But yeah, certainly a very viable option for folks.
Now,
If
I might be thinking about this the wrong way, but if you do a Roth conversion, would you essentially get taxed on it twice because you're putting in after-tax money and then you have to pay taxes on the conversion?
Yes.
Okay.
Yeah. So if you're doing, so you are essentially getting taxed on that twice for a non-deductible IRA contributions.
Well, you would be anyways, even if you left it in a traditional IRA where you're not taking the deduction and then you're getting taxed at the end when you take it out. So
yeah, exactly.
it still sounds like it would probably be more beneficial than that option. But I guess
Yeah,
it
I would
depends
say,
on the
I would
scenario.
think, I would guess so. And we don't really do. I can't remember a time I've recommended doing a non-deductible IRA contribution just for the benefit of tax deferred growth, because that's the big benefit in your traditional IRA is tax deferred growth. But I can't think of a plan I've done for anyone where I've recommended just taking advantage of that tax deferred growth. Usually it's kind of a stepping stone to get it into, tax deferred growth, but we also want that bucket it's coming out of to be tax free instead of taxed at our normal income rates. We're also,
Right.
also taxes go up. They don't go down very often. And judging by what's going on here, I think we're going to see an increase in taxes, especially in the near term. So it's so generally erring on the side of caution. It's the bigger tax-free bucket we can get, the better. Another thing that sometimes gets confused for folks who are newer to investing inside of their 401k or individual IRAs or Roth IRAs. Excuse me. Is the ability to own pretty much whatever investment you want with some limitations inside of any of those vehicles. So if you look at, your, so say you have an individual account, you have a traditional IRA, and you have a Roth IRA. Think of them as three different sports teams. You can really have whatever players you need to fill out your, roster on those teams. But for example, you can't have a MLB player fill an NFL roster. It wouldn't make sense. There's not many Deion Sanders around anymore. So
yeah, I think Tim Tebow gave up both careers at this point, right?
Yeah, I think Tim Tebow's given up on both. So, so the IRA, so whenever we're talking about IRA, traditional IRA, 401k, any of those, or even an individual investment account, that is just a vehicle that holds individual investments. And those individual investments can be stocks, bonds, mutual funds, ETFs, or a combination of all of that. And I think it's, sometimes that gets a bit confusing if you're, newer to the journey. You don't realize that it's just really a tax registration is what those vehicles become for you. So those different accounts become almost a tax vehicle. So they're taxed a bit differently on how they're treated. And, our job is to help maximize your buckets and let you know when to put in which different taxable bucket and when to take out of which different taxable bucket. I always talk about planning. We have two Buffetts involved. We've got Warren and Jimmy. Mike's much more on the Warren side of the brain, right? He's kind of got the science behind all this. And you see, so I think Warren has some hard, fast rules for investment management and financial planning. My brain flows on the other side, which is the Jimmy side, which realizes it's always 5 o'clock somewhere. And so there's a little bit of art that goes with it too. And so with the planning side, we need to be very knowledgeable about the science and the facts, and this needs to happen this way. But we also need to leave room for flexibility, knowing that, if you take budgeting, for example, if you budget down to the cent every month, you're probably going to drive you and your spouse insane. But if you leave some room for flexibility and leave a little bit of room for the art side of it, it gets a little bit less stressful and I think a bit more successful. So just trying to match up all those things is really what we focus on doing. But to answer the question I started with at the very beginning of the day, should you contribute to an IRA? If you have the ability to and the option to, there's a very good chance that it would probably make sense for you to take advantage of contributions to IRAs. But what might even be more beneficial to you, depending on what stage of life you're in, is starting by maxing out your IRA, by maxing out your 401k or Roth 401k through your employer, because those contribution limits are always going to be higher. And once you get to there, then, look at a traditional or a Roth IRA outside of your employer-sponsored plan. That's just my kind of 2 cents, right? I think we have enough moving pieces in our lives day to day. I mean, I got 600 passwords. I have to use a password manager just to stay sane from day to day life. So the less moving pieces you have, sometimes the better. Another benefit to 401ks, 403bs, retirement plans at work is they're generally the lowest cost option. On the flip side, they also generally have less investment options than, an individual IRA or Roth IRA. So, just some things to think about when it comes to a little bit about IRAs, a little bit to think about. If you have any questions, happy to answer those as well. Mike, any questions you have? Any other conversations that pop up from last couple
No,
of weeks?
I think that's it for me. I can't believe it's Friday already. Where'd this week go?
This week is gone. Coming back from a holiday. I know it kind of drags usually coming back from a holiday, but this week did really fly by. I think that's certainly not a bad thing. But I will leave you all with this. I hope you have a fantastic, safe, happy, healthy weekend. Enjoy the. I know Pittsburgh here. The summer's starting to break. I think we're getting up to 80 today, so I might have to go sit on a lawn chair outside or something. Enjoy some of this rare sunshine for us.
Just don't go to a theater, right? Not today.
Yeah, no, just don't go to a theater today. Stay away from that it's too nice of a day to be in a theater anyways. So Mike, as always, thank you very much. Thanks for tuning in, everybody. Happy to answer any questions you have. And then just as a quick reminder too, we're doing our community shred event the last Saturday in April up here in our Bridgeville office from 9 to noon. I would love to have you stop by, and there's a bunch of stuff you can shred. We kind of have a list of it on our Facebook page, and send out an email as well. But love to see you there. And it's for anybody in the community that wants to come out, get some things shredded, have some refreshments, play some games. We would love to see you. So, Mike, stay safe down there, and we'll see you next week.